Hello, everyone, and welcome to the 2021 Virtual Annual Conference by Exponent Philanthropy. Today, we will be talking about foundation legal basics, self-dealing, and conflicts of interest, a topic of interest always to foundations and foundations managers. My name is Andras Casares. I'm with Arnold & Porter. I specialize in working with tax-exempt organizations and foundations. I'm based in DC, and I've been working with Exponent Philanthropy for many years, including doing some of these legal basics and other legal webinars. So here's our overview of what we'll be talking about, trying to wrap our heads around self-dealing and conflicts of interest, both examining what they are, each of them, self-dealing and then conflicts of interest, and how they are similar but different. So just to give the brief overview, self-dealing addresses financial transactions between a foundation and disqualified persons. There are penalties imposed by the IRS, and you want to avoid them, of course. Conflicts of interest is a broader concept that applies not just to financial transactions, but could include non-financial transactions as well, often in the context of grant making, for example. Penalties, that we'll talk about penalties because that can also be within the jurisdiction of the state attorney general. But oftentimes it also just involves bad press and then damage to reputation. And conflicts of interest, when they're non-financial, we talk about managing a conflict of interest, and we'll talk about how to do that. So with respect to, so we'll talk about self-dealing first. There are 3 steps to identify them, and then we'll talk about conflicts of interest next and how to manage them. And I really do, even in my own practice, I really do use these 3 steps to identify and deal with self-dealing issues, because self-dealing is not sort of a common sense or intuitive. As you know, or if you've heard, they have their own little special rules and kinks, and they're counterintuitive sometimes. So you just want to go through these steps. And these are: does the transaction involve a disqualified person? Is the transaction listed as self-dealing under the tax code? And does an exception apply? So we'll go through each. Does the transaction involve a disqualified person? So disqualified persons are several categories: officers, directors, trustees, if you're a charitable trust, or others with similar authorities, right? These are your foundation managers. Substantial contributors to the foundation, the founders. And they can also be not just the original founders, but if a next generation provides additional funding, they could also, they might already be disqualified persons because they're officers or directors, but some of them might not be. So if they give substantial amount to the foundation, then they'll become disqualified persons. Family members of all of those above. The one thing to note is siblings are excluded from that definition, which is interesting, but that's how they wrote it, these rules in the tax code. Entities controlled by disqualified persons, the threshold is 35%. So entities, disqualified persons control at least 35% of the, if it's a corporation, the shares of the corporation, or if it's a partnership interest, etc. And then certain government officials are also disqualified persons. So that's your first step. If you don't have a disqualified person involved in the financial transaction, then you're outside of the self-dealing rules. So it's important, and we sometimes do recommend that foundations just sketch out and identify and just put down on paper all your disqualified persons. Second step is the transaction listed as self-dealing. So these are the 6 types of self-dealing: sale and exchange or lease of property, furnishing of goods or services for money, lending of money or credit, payment, compensation, or reimbursement of a disqualified person. That category is your compensation category, right? If you want to pay, compensate, provide a salary to directors and officers, that's the one that you fall under. Transfer or use of income or assets of the foundation to disqualify qualified person, whose name can be used on the building, who can receive credit. Those are all questions that fall into this category. And then the last one is this payment of money or property to government officials. They have their special rules for that. So let's go through each in detail. The sale, exchange, or lease of property from a foundation to a disqualified person is prohibited unless we fall into an exception where the disqualified person provides to the foundation the property or sale at no charge. So if you want, the most common issue, of course, is the rental of property. If a disqualified person wants to make, wants to provide office space to the foundation, that can be done at no charge, at no cost. If you want to sell something to foundation, you can do that at no cost, at no charge. The second one, does furnishing of goods or services to the foundation is prohibited. So let's take a look at a couple of the exceptions here. So if the disqualified person is providing goods or services to the foundation at no charge, and it has to be for a charitable purpose. And then we'll look at the flip side of that. So if the foundation offers goods or services to a disqualified person, that is prohibited unless those goods and services are offered to the general public and it is related to the foundation's charitable purpose. So the example here is, let's say the foundation has conference space and the foundation generally makes that conference available to the public, maybe for a fee. And if disqualified persons want to use that conference space on the same basis as it is made available to the general public, they can do that. That's sort of the example. Or if foundation happens to run a museum or some other facility, again, the disqualified persons can use it on the same basis as is made available to the general public, but not on a more favorable basis. Okay, let's look at the third exception. Sorry, the third category. So this is our big category about compensation, right? So lending of money or extension of credit to disqualified persons is prohibited. We'll talk about credit cards in a minute. So two things here. So one is the loans, right? So if the disqualified person makes a loan to the foundation, that can be done as long as there are no fees or interest being charged and the loan is used for a charitable purpose. So sometimes this would come up, for example, if, let's say, the foundation has a lot of illiquid assets and for whatever reason they're short on cash to make their grant out, make their 5% payout for the year. The disqualified person could give a loan to provide that cash to meet the payout requirement by the foundation, but the disqualified person wouldn't be able to charge a fee or interest for that loan. Yeah, so I think this comes up sometimes. Again, it can be done. You just have to pay attention to the details about not charging fees or interest. And then the second area here is the payment of compensation or reimbursement of expenses to a disqualified person. This can be done, right? This is done obviously all the time by foundations for their staff, especially in the independent staff foundations, but family foundations as well. This can be done when a foundation is compensating a disqualified person for personal services. And personal services is it's a defined term, although unfortunately not very well defined by the tax code. But based on IRS guidance and precedent, it tends to be professional services related to the charitable mission of the foundation. The tax code specifically defines personal services to include accounting services, legal services, investment management services. We know that it specifically excludes and does not include things like janitorial services and certain real estate management services, but a lot of other professional and managerial services are included that come with managing a foundation. In addition to compensation, the disqualified persons can be reimbursed reasonable expenses incurred in connection with these personal services. So attending board meetings or conferences, educational and other programs. Personal services will include board fees, right? Those are governance and management duties of directors and officers. And it also allows the foundation to buy directors and officers insurance for the foundation, for directors and officers to be covered. Now, all of these, of course, is wrapped up in the fact that any compensation, payment, and reimbursement has to be reasonable and necessary for the work of the foundation. Reasonable is generally determined based on comparability data. That's why we always and often recommend that whenever these compensation issues come up, you look at comparability data that various organizations publish, including Exponent, Council on Foundations, other regional grant-making organizations. And you can also pull up 990s yourself of organizations and foundations that you think are comparable to you to look at compensation. Now, another category here. So that was compensation. This is what I like to think of as a catch-all category. It's the transfer or use of income or assets of the foundation to disqualified person. The exception is if these benefits are incidental and tenuous. So the benefits that flow to disqualified persons from the transfer of use of income or assets of the foundation is incidental and tenuous. So as you say, so these are these examples, as I mentioned. So tickets to fundraisers, fulfilling charitable pledge, naming, recognition, and acknowledgement. So on the naming, you can give a grant, the foundation can give a grant to, let's say, university, and instead of putting the name of the foundation on the building, or in addition to putting the name of the foundation on the building, you put one of the directors' names personally on the building. That can be done. That is not self-dealing, because the IRS on that has specifically said that naming rights and name recognition is an incidental and tenuous benefit. We also know, because the regulations say that fulfilling a legally binding pledge is self-dealing. So if a disqualified person makes a personal pledge and the foundation fulfills that legally binding charitable pledge, that will be self-dealing. And then we also know from IRS guidance that that tickets to fundraisers are a problem if the foundation buys tickets to a fundraiser, grantees, gala, and tries to let individuals other than disqualified persons who are not board members or staff attend that fundraiser based on the foundation's tickets. So that would also typically be self-dealing. So no spouses, no friends. If the foundation buys the tickets to the gala, it has to be limited to board members and staff. There are there are some circumstances that I have dealt with, and you can think about, where even inviting a spouse or a friend, depending on the circumstances, could be related to the foundation's mission because it supports the grantee. So it could depend on, if within the community there's an expectation of certain people to show up, and you are supporting, and it is important to show support to the grantee in the gala, then that could potentially be allowed. It's a very facts and circumstances determination. All of the self-dealing rules, all of these exceptions, unless the rules are very clear, are very facts driven. That's what makes them very hard. Self-dealing questions are always based on these facts and circumstances analysis, and it can be frustrating because there are no clear answers often. So that's and this category, especially because other than the charitable pledge, the naming rights, all we have to go on is this analysis of what is an incidental and tenuous benefit, and it's very facts and circumstances. Now, one thing that I just wanted to point out with respect to the fulfilling of a charitable pledge, so you have that in your mind, is oftentimes you are dealing with a foundation, but you may also have a donor advised fund within the family or family members. So this question can come up, especially based on prior precedent, where based on previous rules, donor advised funds were generally prohibited from fulfilling a charitable pledge of a donor or donor advisor to the advised fund. We have guidance from the IRS from a couple of years ago that changed that rule. And under certain circumstances, if you follow certain rules, you're allowed a donor advised fund. Again, not the foundation, but a donor advised fund is allowed to fulfill a charitable pledge, even a legally binding charitable pledge of a donor advisor to the donor advised fund. It's something to keep in mind, again, because many families have both a foundation, they also have donor advised funds, and these rules for donor advised funds tended to be interpreted as the same as the private foundation rules, but the IRS has provided some guidance in the past couple of years that changed that. Certain sponsoring organizations of donor advised funds may still not allow you to fulfill charitable pledges as a matter of internal policy. So it's something that you'll just have to check with your donor advised fund. And then this last category is payment of money or property to government official is prohibited. And we say, well, see the Exponent's self-dealing primer, which is good, and you should take a look at it. The reason we say that is because the rules are particularly weird and nuanced in this. So if you are inviting a government official to speak at a conference that the foundation is sponsoring and putting together, and the foundation plans to reimburse the government official for the cost of the trip, or they want to pay them an honorarium, or if a foundation wants to hire a former government official or a government official who's just leaving government post. Those are all scenarios that come up. And yes, you do want to talk to an attorney to make sure that that is done properly, because there are specific rules around that. It can be done, but again, it depends on specific the facts of the situation. So it is good to double check that. And frankly, it's not just with respect to these self-dealing rules, but in those situations, you also have to review the government ethics rules, the specific rules that apply to the government official in those circumstances. So you could be in a situation where the self-dealing rules actually allow you to do what you want to do, but the government ethics rules will not allow you to do it. So something to keep in mind. Then, of course, the penalties, right? So the reason we spend so much time on self-dealing and the reason we get so many questions about self-dealing is because there are some very stiff penalties that are associated with that. So if you violate the self-dealing rules, there are 2 tiers of taxes. And the first tier is a 10% penalty that applies to the disqualified person. And this is very important to keep in mind. These penalties do not apply to the foundation itself. They apply to the disqualified person. That's the 10% penalty. And they apply to foundation managers, the board members and officers who approved the transaction, knowing that it is a self-dealing transaction. This is, again, why oftentimes lawyers get involved in this and they get the questions, because if a lawyer provides an opinion that a transaction is not self-dealing, then the foundation managers can avoid being subject to this 5% penalty tax. The disqualified person would still be subject to the tax. So that's the first tiered penalty. Then the second tier penalty is this 200% tax on the disqualified person and 50% to foundation managers if the self-dealing is not corrected. And what we mean by correction in most cases, it is undoing and unwinding the transaction. So if the self-dealing is an issue about excessive compensation, the excess amount of the compensation has to be repaid. If it's charging a rent for office space, that has to be repaid. If it's some sort of transaction that can be unwound, that has to be unwound. If it is not, then this penalty jumps to basically 200%, again, for disqualified persons and 50% for foundation managers. These are intended to be punitive damages. Punitive. They are absolutely meant to put people on alert that they should not be taking self-dealing rules lightly, and they should be careful about them. So that's what these penalties are intended to be. Okay, conflicts of interest. So conflicts of interest, in the way I view conflicts of interest, is a broader category. For me, that's sort of the overall category, and self-dealing is a subset of a conflict of interest, right? Self-dealing it catches generally financial conflicts of interest, where there's some sort of financial benefit or economic benefit. With a conflict of interest can include both financial and non-financial. So a situation that arises at any time a foundation board or staff members role at the foundation intersects with their outside roles or relationships. It provides the individual an opportunity potentially to benefit personally, again, whether financially or non-financially, from the foundation in a direct or indirect way. So it can be fairly all-encompassing. So these are a couple of examples that just to orient ourselves. So foundation board members serving on a grantee's board, a very common situation that usually does not involve any financial conflicts because the grantee usually is not going to pay board fees. A foundation board member's nephew serves as the executive director of the grantee. Right, so this comes up as a self-dealing example because, again, let's go back to our self-dealing analysis. Do we have a disqualified person here? Well, the nephew is not a disqualified person because we know that siblings, right? Siblings don't include disqualified persons. So the nephew, as a result, is generally not going to be a disqualified person unless the nephew is also on the board of course, on the foundation. So this would be outside of the self-dealing rules, but within the concept of the conflict of interest rules. Same thing here, the last one, the spouse of foundation board member has a brother who owns a business that may become a vendor to a foundation. Same thing, it doesn't fall within the definition of a disqualified person, but it can be, it's a financial transaction with a board member that involves a board member, and you have an ability of the board member potentially to benefit indirectly. So with conflict of interest, we talk about managing the conflict. And this is where our conflict of interest policy comes in. It allows us and provides the steps and lays out the process of how do we deal with a conflict of interest. So one is, of course, we have to know about conflicts of interest. So that's why we usually recommend that there's an annual disclosure, one of those written annual disclosures that you see that's attached to your conflict of interest policy. But also at the same time, imposing a duty on board members and officers to disclose conflicts and transactions as they arise, because there may be new ones and we may not know all of them. So that's one. Step two, then, follow the policies and procedures of your written conflict of interest policy. And once you have disclosure, what you have then is a process that independent board members should decide whether something qualifies as a conflict under the conflict of interest policy. And again, you can define it in a variety of ways. And if it does, the potentially conflicted board member should not be participating in that determination, but could provide information. And let's say that decision is made that it is a conflict. Then the board, the independent board members should decide without the conflicted person participating in that discussion and vote, whether to go ahead with the transaction or not. And then whatever decision the board makes should be done, should be recorded, including the recusal in the board minutes. And of course, you might be asking, well, if we're a family foundation and we just have family members, none of them are really independent, how do you make that decision? How do you have independent board members to make a decision? And the simple answer is that you don't. You do your best. In those cases, you do your best to exclude the conflicted person and have the other remaining board members make a decision. And again, when it's a non-financial conflict like grantee decision-making, grants, it's less of a legal issue because you don't have a self-dealing problem, you don't have a financial conflict of interest issue. It's more of the appearance and perception, so you have more flexibility in how you decide to handle that. And then, so let's talk about the penalties, right? So we talked about the monetary penalties that apply in the self-dealing context. Here with conflicts of interest, it is more of a reputational test, right? A reputational damage. It could trigger an audit by the IRS, but it is, if it's a non-financial conflict, it's more likely to trigger a review by the state attorney's general office. The state AG is the one that has jurisdiction and oversight of foundations and charitable organizations within a state, and actually has a lot more broader and more flexible powers to remedy a situation than the IRS. The IRS's ability is to impose those penalties that are laid out in the self-dealing rules. And in egregious cases, the IRS has the ability to revoke the tax-exempt status of an organization, of a foundation. But that really is in egregious cases. In contrast, the state AG's power includes imposing penalties, monetary penalties, requiring the foundation to undo the transaction. The state AG also has the authority to remove board members, to change the board members of a foundation. Again, that's usually done in egregious cases. And the state AG also has the ability to seek the dissolution of a foundation or a nonprofit organization at the state level, right? Because ultimately you're a state organization, whether you're in a nonprofit corporation or a charitable trust, the state AG would have the ability to seek dissolution at that state level of the entity. And then the AG talks to the IRS. So the AG often refers cases to the IRS. I've had this happen with clients where the state AG is looking at somebody's 990 or is looking at an organization and they're not happy with something, but we end up resolving it with the AG's office. But then all of a sudden, 6 months later, you get an audit letter from the IRS. Well, they found the IRS was notified by the AG. That's how they found out. That's why you're getting an audit. If you're talking to the AG, you should also be prepared to eventually receive a notice from the IRS as well. So let's talk a couple of just sort of tricky, interesting situations. And we think about, how do you categorize these? How do you think about them? Is it self-dealing? Is it conflict of interest? And all of these definitions can be very confusing. You want to look at the federal tax rules for the self-dealing definition. You want to look at your written conflict of interest policy for conflict of interest matters. You also may and need to look at the state conflict of interest rules. So as you probably know, most states have a nonprofit corporation statute. If you're a nonprofit corporation, that statute applies to you. If you're a charitable trust, there are some certain trust and state rules that apply to you. It's always worth looking at those state statutes to confirm whether you have to abide by any specific requirements for conflict of interest transactions generally. And for example, in New York, the New York nonprofit corporation statute actually requires all nonprofit corporations, including private foundations incorporated in New York, to have a written conflict of interest policy that includes certain things in that policy. So you want to take a look at that. And it's not even if you're not incorporated in New York and those New York rules don't apply to you, it's useful to look at it and to see what they require. So you always want to check state law as well. So follow the self-dealing definition from the IRS rules. That's your step one. Figure out if you are within the self-dealing rules. If you're not within the self-dealing rules, then you want to look at your conflict of interest policy, your written policy. What does it capture? State rules, what does it capture? And then I think last, if you're confronted with a situation that hasn't arisen before, figuring out whether it's something that you should add to your policy or clarify. And for many situations, especially non-financial conflicts, it really is a policy matter for what the organization wants to do. You know, there are foundations that do not address non-financial conflicts, and they are, or they do address them and allow them. So again, this grant making to grantees where they're overlapping board members, because for them, that's how they get input from a grantee, or it's a way that they've always supported grantees, and that's important. So they're not going to, they're going to allow for that non-financial conflict of interest, but they're going to manage it and have a policy of how they do that. Other foundations don't like those conflicts and avoid them for a variety of policy reasons. So these are sometimes just judgment calls and decisions that you need to make internally as to how you deal with certain things. And there may not be a right or wrong answer. You just need to know why you're doing it and be very transparent as to why you're doing it and how you handle it. So I think we wanted to go through a couple of examples here. So this is a situation where you have a daughter versus a sister of a foundation director who's an employee of a grantee. Right, so where is our mind heading? You know, self-dealing, conflict of interest, all of the above, everything. You know, we're confused. How do we analyze this? So we go through our steps. Here, let me stay with this slide here. So first step was self-dealing, right? Let's recall our steps. And I do this, I've done this for many years. This is still how I look at self-dealing issues, just to keep myself oriented. Does the situation involve a disqualified person, right? The daughter of a foundation director would be a disqualified person. The sister of a foundation director, as a sibling, would not be a disqualified person, right? So on the one hand, we have a situation that would imply self-dealing. On the other hand, we have a situation where it would be just a conflict of interest. So that's, you know, then you go through the rest of your analysis. If it is the daughter, right? So it's a disqualified person. She is an employee of a grantee. And the way, you know, if you are providing a grant to the grantee and the grant is used to provide the compensation of the employee, does that fit within any exception, right? Because that is, in that situation, the grants or the assets of the foundation would be used to provide compensation to a disqualified person. And we know that that is generally prohibited unless we have an exception. And the exception is the personal services exception. Here, do we fit within the personal services exception? Well, the daughter is an employee of the grantee. The daughter is not receiving compensation from providing services to the foundation. So we don't fit within an exception, and that would be prohibited. So when we encounter these kind of situations, what we recommend is that the grant agreement specify that the grant shall not be used to provide compensation or any types of payment to the daughter, the disqualified person. That's how you wall off the grant. So you could still make the grant to the grantee. You just specify that the grantee cannot use any of the grant for the daughter. And then in the second case, the sister. So we're not dealing with a disqualified person. We're dealing with a conflict of, so it's not self-dealing. We're dealing with a conflict of interest issue. So then you look at your policy. How do you deal with that? What do you want the answer to be? And you could include, you could have a variety of things, including that you get to the same result as in the self-dealing analysis, that you allow it, but you wall off the grant. And on top of that, then you follow your process of, is this a transaction? Is this an arrangement that we want to allow? Do you have quote unquote independent directors who can analyze the situation and make a decision about whether to enter into this grant or not, if your policy doesn't otherwise give you an answer already. So that's that first situation. The second is trustee provides legal versus landscaping services to the foundation. So again, here a trustee, we're dealing with so let's do the self-dealing analysis. Trustee's first step, identify whether there's a disqualified person. A trustee is a board member that is a disqualified person. Is it one of those prohibited self-dealing transactions, right? It's services to the foundation. So you're paying for services to the foundation. So yes, it is in that category of paying compensation to disqualified persons for services provided to the foundation. So it's generally prohibited. Do we fall within an exception? So again, the exception is this personal services exception. What is the definition of personal services? Well, we know that legal services fall within the definition. And we know that, so that would be permissible. And we know that landscaping services from IRS guidance, we know that that is not within one of the exceptions. So that would be prohibited. So that's the answer to your self-dealing question. The legal services would be prohibited under the self-dealing rules. The landscaping services would not be under the self-dealing rules. And on top of this, now you could move on to that second set of analysis of conflict of interest. You could still have the situation addressed by your conflict of interest policy and make a decision about whether you allow this or not. And that would be a policy choice for you to make. The reason we like having written conflicts of interest policies that address these kinds of situations is so that you can apply them consistently no matter who is involved, which is especially important in family dynamic context, right? You can use the policy to be consistent and fair and even-handed and applies to all situations, again, no matter who is involved. That's the benefit of a conflict of interest policy. So finally, again, just want to leave you with this chart again to help you orient what the basic distinctions are between the self-dealing transactions and a conflict of interest, and the differences and how to analyze them. Use those basic steps. Even though the self-dealing transactions are very fact specific, they can still help you figure out, is it self-dealing? Is it not? Where do you fit in within the rules and the exceptions? And then if you still have questions, then you can turn to Exponent or other resources or your attorney or accountant and try to work it out with them and go through the facts and see where you land. There is really no shortcut to this analysis, especially in the self-dealing rules, because they tend to be fairly counterintuitive. So with that, thank you very much for your attention and for again participating in the Exponent Philanthropy Annual Conference, and hope you have a good rest of many sessions. Thank you.